All right, traders, welcome. Today, we're going to get into the one thing that truly separates the consistently profitable from the 90% who struggle. And I'll give you a hint, it has nothing to do with finding that perfect entry. It's all about mastering your defense. We're breaking down the two core philosophies you absolutely need to know, fixed versus dynamic risk. Let's dive right in. This quote from Blackbird Trading just hits the nail on the head. So many new traders, they obsess over finding the perfect signal, right? That one magic indicator that's going to tell them when to buy or sell. But here's the hard truth. Your survival in this game, it doesn't depend on being right all the time. It depends entirely on how you protect your capital when you are inevitably, and I mean inevitably, wrong. Okay, first up, let's talk about the foundation, fixed risk. We're starting here because this is the bedrock. This is the absolute non-negotiable for any trader who's serious about staying in the game long term. Before you can even think about going on offense, you have to master your defense, and this is it. At its core, fixed risk is actually beautiful in its simplicity. You just decide on a set percentage of your capital to risk on any single trade. Let's say it's 1%, and you never, ever break that rule. So if you've got a $10,000 account, every single trade you take has a maximum potential loss of $100, period. It doesn't matter if you feel super confident or just a little unsure, the risk is always the same. What this does is create a predictable, mathematical structure that starts to pull that destructive emotion right out of your decision-making. As you can see here, the goal isn't to hit home runs. It's pure, simple capital preservation. And why is that so important? Because as a developing trader, your most valuable asset isn't actually your account balance, it's your time in the market. Think of it like paying tuition for your trading education. By making sure no single trade can seriously hurt you, a fixed risk model guarantees you can survive your own learning curve. Imagine you're trading gold. Whether you see a textbook breakout or just a choppy, messy setup, your downside is always capped at that same $100. This lets you take the setups, collect the data, and learn from what happens without the fear of blowing up your account. All right, now for part two, dynamic risk. See, once a trader has truly mastered the discipline of that fixed model, they can start to evolve their game. This brings us to dynamic risk, and this is what you could call the pro's edge for really optimizing performance. This is where you shift from playing pure defense to playing smart, strategic offense. Dynamic risk is all about being selective. It means you stop treating every single trade as if it's equal, and you start acting more like a professional poker player. When multiple factors line up perfectly in your favor, what traders call confluence, like a strong trend, a key support level, and a great-looking candle pattern, well, that's a strong hand. You bet more. But when the setup is weaker or the market's just not cooperating, you bet less, or maybe you don't even play the hand at all. This isn't random gambling. It's a methodical way of putting your capital to work based on a proven statistical edge. So how does this actually work in the real world? It's this simple three-step process. First, you spot a potential setup that fits your rules. Second, and this is the critical part, you have to objectively grade its quality. Let's use Bitcoin as a concrete example. An A+ setup might be a clean bounce off the 50-day moving average, which also happens to be a major support level from last month, and it's confirmed by a big, high-volume bullish candle. That's a high confluence trade. You might risk 2% on that one. Now, a C-grade setup, that might be a similar candle pattern, but it's happening right in the middle of a choppy range, and it's going against the main trend. It technically fits a rule, but the context is just terrible. On that trade, you might only risk 0.5%, or you know what? You just skip it entirely and save your capital for those A+ opportunities. This table right here, it just lays out the two philosophies perfectly. Fixed risk is like your training wheels. It's simple, it's consistent, and its entire focus on survival and building discipline. It's about laying that strong foundation. Dynamic risk, that's building the skyscraper on top of that foundation. It's more complex, it's adaptive, and it shifts the focus from just surviving to actively maximizing your profits on your best ideas. So with gold, fixed risk means every trade is a $100 risk, period. With dynamic risk, that A+ breakout might be a $200 risk, while that choppy C-grade setup is only a $50 risk. You're being smart with your money. Okay, section 3, choosing your strategy. So this is the big question, right? Which of these is the right fit for you right now? This is going to take some honest self-assessment, so let's break down how you can decide. I need you to be brutally honest with yourself here. If you are new, if you are struggling to be consistent, if you're still proving your strategy even has an edge, or if you find yourself making emotional decisions, you must stick with fixed risk. It's your shield. It's what keeps you in the game long enough to learn. You should only even consider moving to a dynamic model when you have objective proof of success. I'm talking, say, at least 2 profitable quarters in a row using your fixed model. You also need a proven, back-tested system for grading your trades. And most importantly, you have to have the discipline to follow it without fail. And that brings us to maybe the most important part of all of this: risk, rules, and mindset. We have to talk about psychology, because this is where even the best laid plans fall apart. Dynamic risk is incredibly powerful, but you know what? It's also a siren's call for your ego. It can tempt you to bend the rules, to call a trade A+ just because of a gut feeling, and to put on too much size based on hope instead of hard evidence. Without an ironclad mindset, a dynamic model can become a fast track to blowing up. So the crucial point is this: it doesn't matter how sophisticated or pro your model is if you can't execute it flawlessly. The best risk model in the entire world is the one you can follow with absolute 100% discipline, especially when the market is going crazy and your emotions are running high. Consistency in your actions will always be more profitable than a complex strategy that you execute inconsistently. And really, it all just boils down to this single, powerful idea. 1% risk. Focusing on one rule at a time. Your number one priority always is protecting your capital. This number represents that singular focus you need to succeed. You know, in volatile markets like crypto, some traders will even use a metric like the average true range, or ATR, to define their one unit of risk. They're tying their stop loss directly to how wild the market is right now. But even then, the principle of a defined, disciplined 1 remains the anchor that keeps you grounded when the market is trying to shake you out. So I'll leave you with this question. Based on everything we've talked about, I want you to take a moment and honestly assess your own trading. Which of these models fits where you are on your journey right now? Are you still building that foundation with the discipline of fixed risk, or have you earned the right to start optimizing your performance with a dynamic approach? There's no wrong answer here, only the honest one for your journey. Let us know which one you prefer and why down in the comments. Thanks for watching.